Hey, good morning again, and welcome back, options traders. Well, a topic that I've covered many times before, at least in different angles, but I think is one of the most important topics in options trading, is why quote options in volatility terms. And little interesting story, back when the SIBO was first started, back in 1973, there were actually conversations about quoting options in volatility. And they decided against it, and probably a good idea, but they decided against it because they thought people are just going to find it too confusing. So they chose to quote them in dollars and cents, which is how we see them today. However, most of your brokerage platforms will still show you quotes in volatility terms. And while there are certainly times that we may want to look at the dollar values, maybe if we're selling against something, we'd like to know actually how many dollars we're going to receive. You still need to understand that to succeed with options, you need to understand the volatility terms. So why is that? Well, it's a very good question. It's very hard to understand because we have to talk about this esoteric topic of volatility. But I was just speaking with some traders the other day, and I came up with a little analogy that they said really helped to understand. So I thought it might help the rest of everybody in this group. So let's go find out what it is. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So for a little background, let's start off with some bond math. And you're probably thinking, bonds? What has this got to do with options? Well, hold on for a second and you'll find out. But first off, let's say that you are looking for a face value of $1,000. And this just simply means that when it matures, you're going to receive $1,000. To make it simple, let's also say it's a zero coupon bond, so it pays no interest payments during the life of the bond. It just pays the face value at maturity. We also know that this bond is yielding 5%. Well, the question is, what's it worth? Well, it's fairly easy to figure out. You're just going to take this $1,000 face divided by 1 plus this interest rate, 1.05, and we get 952.38. And what that means is that if you paid $952.38 and then collect $1,000 in 1 year, that you have earned 5% on your money. That roughly this $48 difference is your effective interest. Now, what if it were a 2-year bond? Well, it's the same basic idea, but we have to divide by 1.05 twice. And mathematically, that's the same as dividing by 1.05 squared. So if this were a 2-year bond, we take the $1,000 face divided by 1 plus the interest rate squared, because that's the number of years, and now we get a price of 907.03. And notice that when we start pushing this out further in time, or if we were to increase the interest rate, this price is going to get cheaper. So that's what's allowing us to earn more interest over time. So if you paid 907.03 and collected $1,000 in 2 years, then your yield is 5% per year. All right, so kind of hold this idea of these bond calculations, and now let's take a look at bonds. Let's say that you want to buy a $1,000 face bond, and you're willing to buy any number of maturities. You actually have a lot of different investments that you'd like to do, so you're willing to buy any maturity up to 2 years. However, you are looking for a 5% return on your money. So now, with all of this information, the question is, what's the most important factor? Is it that it's 2 years to maturity? What if it's 1.8 years, or 1.9, or 6 months? Does it really matter? No, we said that you were willing to buy any number of maturities up to 2 years. Is the dollar amount entering into the decision? Does it matter if you pay $930 or $950? Well, it really shouldn't, because what you're after is a 5% yield. So let's say that you look on your broker's platform and you're looking at all of these different bonds. We have 360 days to maturity, another one at 180 days, 720 days. Here's a 2-year bond, 90 days, and then one with 271 days. And here are all of the prices. So now think about it. If you're trying to fish around for a bond that meets your needs, which one do you take? See, price shouldn't be the factor. Again, does it matter if you paid 952.38 or 951 or 977? See, you know that the price is going to be close to 1,000. It's going to get a little cheaper as we go out in time, but your main concern is the yield. So now that you have this information, what do you have to do? Well, now you have to pull out a calculator and go through those fairly complicated or at least tedious calculations. So we put this into our calculator and we find out that if you pay 952.38 for a 1-year bond, this one we saw ends up yielding 5%. So we go, okay, that gets a green check. That might fit our needs. What about this one down here with 180 days? I don't know. I'm not worried about the price. I'm worried about the yield. So we got to get out our calculator again. We go through those calculations, and it turns out that this one comes up to be 5%. We see another one. Here's a 2-year bond priced at 907.03. Is that cheap? Is it expensive? I don't know. I'm not really worried about the amount that I have to pay. I'm worried about how much I'm earning on my money. That's my goal. So we get out our calculator again. We do the calculations. It turns out that this is 5%. And we go through these bottom two, and they all turn out to be yielding 5%. Well, now we get a little different picture. See, when we were looking at these prices, it was really hard to say which one would suit our needs. But when I price them in terms of yields, it's obvious. They're all equally good. They're just different maturities. But they are all priced the same. But notice when I say they're priced the same, they're not priced the same in dollars and cents. They're priced the same in terms of their yields. So professional traders would actually say, if you ask for a quote, they would say on this first one, it's quoted at 5%. And then, yeah, if you wanted to figure out the price, you could go through those calculations and do it. But again, that wouldn't really matter. When you go to buy the bond, you're not worried if it's 952.38 or 951, whatever. It's just some price that yields 5% over a year. Let the price fall where it may. See, this is not anywhere nearly as interesting as this. So this is why professional traders would look at these and say, oh, they're all 5% bonds. Now it just makes the decision easy. Find which maturity you're looking for and let the price fall where it may. All right, so remember, this is the most important category right here when you're pricing bonds. And now hopefully that makes a lot of sense. So now keep this idea in mind and watch what happens when we apply it to options. So let's say that you want to buy a call and you're willing to buy any days to expiration up to 120 days. But you want to be sure the volatility is in line with the historic volatility. I've often made the analogy that volatility is like a point spread in a football game, that extrinsic value on the option. Do you want to take a bet just because it appears cheap, even though your team has got a 30-point spread against it? Hopefully not. But a lot of traders end up doing that because they're not looking at how the option is priced in terms of volatility. So when you're buying these options or setting up your strategy, what's the most important factor? That you can pay $3 for it? Or $2.90? Is that going to be a deal breaker? Or $3.50? See, price really shouldn't factor into it as much as what is that price in terms of volatility? I want to know how big the point spread is. So now when we go to our options chain, let's say that here are some option prices. Here's a option with 7 days to expiration. Here's one with 30, 45, 90, and 120 days. Well, see, now it's confusing because they're priced in terms of dollars. And this is why so many traders make mistakes. They'll say, oh, this one's cheap because it's priced a little over $2. And, oh, this one's way too expensive. It's over $8. You don't ever want to pay $8 for an option. And they'll kind of look through here and say, okay, maybe this one looks pretty good. I'm willing to pay $4. That'll give me 30 days. That looks like a good price. Well, we can do the same thing as we did with the bonds, just with more complex math, by putting these into an option pricing model. And if we look at a price of 204 with 7 days to expiration, assuming no interest rates, we end up with a volatility of 37%. See, this tells me a lot more about what I'm getting into. I look at this option at 423 with 30 days. Is that cheap? Is it expensive? I don't know. They're priced in dollars. But if we go to a pricing model, put it into the implied volatility calculator, it turns out that it's also priced at 37%. And so is this one, and this one, and this one. So a professional trader would look at this and say, these are all priced the same. But a retail trader would say, what do you mean they're priced the same? Look at this one's almost 4 times as much as this one. How can you say they're priced the same? So you start falling into these optical illusions and these traps because you're looking at things in terms of dollars. And the dollars really tell you nothing about the type of game you're playing, so to speak. Again, are you willing to bet on your football team if there's a 3-point spread against them? Probably so. What about a 14 spread, 21, 30, 35? At some point, you got to draw the line and say, no, I'm better off betting on the other team. And that's what happens if these volatilities start getting too far out of line. So this is why professional traders say, show me the volatility number. I want to know how these options are priced in terms of volatility. I don't really care about the dollars. I don't really care if, again, back to the football analogy, if Vegas says you have to bet $4.23, well, that might sound cheap, but what if there's a 30-point spread against your team? See, now it looks really expensive. And yet you might look at this one and say, wow, it's $8.45, that's really expensive, but there's a 1-point spread against your team. Well, now it looks really cheap. And that's why professional traders want to know how these options are priced in terms of volatility, not in terms of dollars. So to see that, let's jump over to the E-Trade platform and see where professional traders look when they're quoting options. So now we're into the E-Trade platform. I'm going to use Home Depot here for the example, trading for just a little over 362. And here is the September expiration with 32 days till expiration. Now again, this is for other reasons, depending on our needs and our strategies. But what we're really trying to find out is, what about the value? Not worried about the dollars and cents. What am I paying for? Well, see, if we look at, let's go to the at the monies, let's say 362 and a half right here. They're about $8.30 on the asking price. And some traders right off the bat say, oh, that's way too much for an option. Well, how do you know? Is it really much more than if we looked at the September 6s? There's a 362 and a half trading for 665. Is that any cheaper? See, I don't know. All I'm looking at is dollars and cents. But notice that if I look over here on the implied volatility, now I can actually look at the bid implied volatility or the asking implied volatility, or I can kind of look at an average right here. They're priced at, let's call it 20% volatility. So if I come back to these, here is the 362 and a half. They're priced about the same, 19.3. So they're all priced about the same. And I can see that from this column. But you'll find that sometimes when you're coming into earnings, especially for something like a tech stock or a biotech, you might find that a lot of these expirations are, let's say, at 19 or 20%, and then suddenly there's one at 60%. Well, you need to be really careful there, but you would never notice that by looking at dollars. We need to know what the point spread is, and that means we need to know the volatility. So once we have that, we can go to a historical volatility chart and say, where does this price land relative to historic? So right now we can see that they're priced at about 20% volatility. But if you look at kind of the recent history, they were up around 30%. But that's because Home Depot just released earnings a little over a week ago. And so that's what you're seeing is this big spike in volatility right here. Well, yes, you have to be very careful through here. But how would you know that if you're looking at an option that's priced at $5 or $6 or $8? You don't know. But you absolutely do know when you price it in terms of volatility. So, again, I know this is a question that I get a lot from traders or when I talk about things being priced in volatility, and people just don't understand why. But if you think about pricing a bond, or if you were shopping for bonds, you don't really care what the price is. You care what the yield is. That's the reason for buying the bond. And the same thing with the option. It's not because you think the price is going up and let me buy a call. It's what volatility am I paying? And the only way to see that is to look at volatility. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.